Go positive and go first. Peter Kaufman. Berkshire meeting. I was very upset that we couldn't make it out. There was no live hosting this year. It was all remote, virtual. We're going to do a quick summary of what went down from, the biggest Berkshire fans that you could probably find.
Let's break down everything they talk about, because they talk a lot and they talk very, very slowly.
So first topic, macro view of the market. And they touched on inflation. In a nutshell, Buffett was questioned on it, and he said, look, all of our subsidiaries are seeing high level inflation in the supplies. And so as a result, all of their prices are being raised. What is the result of this? I mean, Buffett didn't really put it this way. This is my wording, that with money print to go brr, which we've explained before, and low interest rates, what do you expect? I genuinely think we have not yet even seen any of the consequences or second order effects or any of the lagging indicators of the actual money printing that's happened. We haven't even seen the start of inflation, and I totally resonate with him on that one. What do you make of that?
He's got a point. He talks very much from a very simplistic view of macro level economics. On this program previously, we've talked about how macro is BS. But the point is, I think he is right. It's simple economics in the sense that prices are going to rise. You're going to see an asset value increase, and therefore potential for share price increase or other assets, not non-share assets. But he also talked about Keynes, and Keynes has a general theory called true inflation. I'm not sure the two are related. I'm not sure if he was referring to the Keynesian view of inflation, where you have an increase in effective demand, it causes money costs and prices to rise in proportion to that increase in demand. I think that's all he was saying, is he was just taking a Keynesian view.
Cool. Next topic. None of the top 20 companies from 30 years ago by market cap are in the top 20 now. We're going to put a screenshot up of this if we can. There were definitely a lot more Japanese companies. Wow. They pretty much dominate the list. And the list we have now is pretty much dominated by US. I think part of this was he was getting grilled on just overall holdings, and people say, okay, well, you buy things with the intention to hold for a very, very long period. And then he hit back with, yes, hold for a long period. But from what I understand, he said, it doesn't mean that holding for a long period will give you the results that you think. That's not just because some people are obviously stupid. Some of these shareholders, no offense, they hear Berkshire, it's probably the only thing they hold. They're not investors. And as Buffett advises himself, he says, you should put your money into the S&P 500 index. He says, I've recommended it many times. And when people grill his performance over the last 10 years, it actually offends me, because you're taking hits at literally the GOAT, him and Munger, the GOATs, and you're saying that you're criticizing his performance. Yes, but what about the 50 years before that? And even if you look at their 50 years, there are actually many periods of cyclicality where performance dips for a few years. And this could just be seen as an extended run of that. People criticized his tech. He went into Apple. He went into Snowflake. But in a nutshell, yeah, it's no surprise, especially with technological innovation. I think where 30 years ago, those 20 companies are no longer on the top 20 list, companies on the current top 20 list, they're actually going to fall off much quicker than the previous companies fell off 30 years ago, simply due to the level of innovation that we have going on right now. You look at the old list, it's dominated by oil and gas, finance, banking, and now it's pretty much dominated by mostly tech. I think this list, we're going to be seeing changes faster. As we know, as we discussed with Paul Quattrocasas on one of our episodes, he loves Munger and Buffett, and he's published a report on value investing is dead. We'll link it in the show notes. His thoughts on what we discussed, it is pretty much dead. And so you've got people like Terry Smith who are pretty much growth investors. It doesn't mean any growth. It doesn't mean he'll invest in shit companies like Uber who are unprofitable. He has his own growth strategy. And these guys, I think the value investing hasn't worked. What do you make of the current list pretty much being dominated by predominantly tech companies in modern day? They're going to fall off much faster due to innovation. You've got to be a really switched on investor to know what if this is your full-time job. Warren says himself, and many people often say, if you're not passionate about this to the extent that you read 500 pages of annual reports a day like Warren Buffett, who's still getting beaten in the market, by the way, currently by the index, if you're not that passionate, it's not for you. He says when he passes away, I think something like 99.7% of his wealth is going straight to charity. Of the other 0.3% that remains for his widow, it's all going into the S&P 500 index. It's not even going into Berkshire. He's not even giving it to his own people to manage for his wife. He's putting it in the S&P 500 index. So I don't know what you make of all this.
So a couple of things. The first is that if you look at companies now versus companies in the past, so he pulled up, you know, how Buffett and Munger love pulling up slides. The slide he pulled up, obviously in like Times New Arial font. The countries that are the biggest are Japanese countries. And so you've got, I think, 13 out of the top 20 were Japanese. Those all fell out of the top 20 simply because Japan had a poor run and negative growth for a while. And a lot of those, you're right, are banks and oil and gas companies. Royal Dutch Shell is the only European company in that list, as it was called back then, Royal Dutch Petroleum. But yeah, there's a lot of banks, there's a lot of oil and gas, and there's a lot of manufacturing. If you look at today's list, the top company by market cap is Saudi Aramco. So you still got oil and gas in there.
It's the exception.
It's the exception. Everyone else, all of them, to be honest, have some level of tech integration, which goes back to the Paul Quatchikasas episode we did, which is you don't have to be a tech company to become a tech company. So how you leverage your business model, how you shift into tech, how you do a tech transformation or digital transformation, be it through cloud or through any other form of technological innovation, you can therefore become a tech company. So if you actually look at the list now, you've got Microsoft second, Apple third, Amazon fourth, Alphabet fifth, Facebook sixth, Alibaba seventh. But then the rest are like Berkshire, Johnson & Johnson, Visa, Walmart, Nestle. So these guys have actually acquired, they've undertaken good M&A in the space, and I think that's why they're doing well. In reference to his other point around, you know, we don't know what the future's gonna look like. I think a lot of the fact that a lot of those companies that were in the list, that were Japanese, that are now not in the list, it was a more macro point reflective of the Japanese economy as a whole and decisions from that government. I think the list is less likely to change going into the future, apart from one major factor, and I think that major factor is regulation. So if your Apples, your Googles, your Facebooks get regulated more, particularly around data capture and how they use your data, I think at that level you have a potential for a shift in that top 20. Otherwise, they have such a strong position in the market. As Peter Thiel says, it's all about building a market and holding a monopoly in that market. This is how these guys win, and this is why they are winning. And so I'm 50-50 on the fact that this list may change in the future. But as he says, invest in index funds, spread your bets across the whole platter of companies, and you're probably going to be golden because you're betting on the US economy.
But what about Lambos and Ferraris? What about quick returns?
I still think you're going to get quick returns with tech companies.
What about Dogecoin? What about quick returns? But I want fast cash.
This is the thing. So if your mentality, you've written a really good article about this on our website on financial minimalism. There's two ways of thinking about this market. Either you're in the long term, I want to make money and be secure for the rest of my life.
AKA us, AKA the very, very, very few people left.
I think that's the rational approach. Then you've got the opportunistic approach. I think the opportunistic approach gathers pace and gets a lot of fire behind it when times are like this.
Dogecoin is not opportunistic, bro.
Yeah, to an extent it is. It doesn't have any value. It doesn't have any value or use case, but it is opportunistic because some idiots are pushing it sky high and people are making money. Why didn't Berkshire buy more then in this scenario?
If I recall, I mean, it was a long freaking 4-hour stream of these two guys talking at like 0.25x pace, as much as I love them. I think Warren put his hand up and said, yeah, look, we could have and we should have, but that's not how investing always goes. He says, it's exactly what we said on a previous stream around, which we'll link, around market bubble popping and things like that. No one can predict the market. Not even the goatest of goats can predict the market. So for him, it's all about being strategic. It's somewhat of a game of chess for him in that he has to be very strategic. He's got a big cash balance. He's got a certain buffer, or as he calls a margin of safety, that he doesn't like to fall below. And he manages the largest holding company in the world. So for him, it's not like these bros with their small funds just throwing a bit of money here and there at a dartboard hoping something takes off. He put his hands up. He said, yeah, you know, when things fell off back in March last year, 2020, there were things we could have bought, but there were also good things he did. He offloaded some of the airline stuff that then further decreased in valuations even more substantially after he offloaded. I mean, I think Morgan Housel touched on this in The Psychology of Money, or somewhere I read this. I can't remember where it was. That this is the psychology of investing, and you're either rational and you use it to your advantage, or you get screwed over by it, which most people do. And what do I mean by this? You sell something, 2 days later, you're like, but the price has gone up to this. You dwell on the things that you could have made. You're not happy that you took a profit, and the saying goes, any profit is a good profit. But in many people's cases, they get depressed that, I could have made more money. Why Buffett didn't buy more? Well, if you believe in people like Greg Abel, Ted and Todd and Ajit and all of these guys at Berkshire, you know that 30 years from now, they can look back to the people that said, why did you not buy more? And say, yeah, but what about the results now over the last 30 years? People are too focused on the micro in that chart, and it goes with everything in life. We've discussed this before without getting too philosophical. People are just too micro focused in the next 6 months, not even people are focused on the next 6 hours, let alone 6 months. Whereas these guys are in the multi-decade game. So anyway.
All right, let's touch on Crazes then, because that leads on quite nicely into everything that's happening from...
I'll let you speak. I'm going to have a heart attack. I'll let you speak.
Everything from Robinhood to SPACs to Bitcoin. These guys touched on, and there's two ways to think about how they responded to these crazes. The first is to think, and I think this is the easy way out, I think this is the lazy explanation, is they're out of touch with technology and they don't understand what movements are occurring in the market, and therefore their view is nothing but an old man's view on the situation. The second way to think about how they've sort of termed their views on this situation was that they're speaking from experience and historical fact. They're basing what they're saying on very simplistic historical fact and very simplistic mental models that enable them to essentially cut out all the noise and the bullshit and come to an answer. What they came to an answer for Bitcoin won't surprise you. I mean, we'll pull up on screen what Munger said about Bitcoin, but he absolutely despises it.
Can we get to Robinhood first, because I've pulled it up, and then we'll get, because Bitcoin is a different discussion while we're on the topic of stocks. So I'll read it quickly. We'll see if we can put it up. Warren said regarding fintechs and trading apps such as Robinhood, I'm looking forward to reading the S1 on Robinhood. It's become a very significant part of the casino aspect of the casino group that has joined into the stock market in the last year. I do want to see how they handle their source of income when they say they don't charge the customer anything. Interesting to see how they describe it. They have attracted, or maybe set out to attract, 13% of their casino players who are in puts and calls. We're not even counting those who are going into stocks. And a lot of the put call players in the market are now coming from Robinhood. It's not the most admirable part of American accomplishment. And Charlie said, that's really waving the red flag at the bull. I think it's just awful to draw investment from decent citizens. It's deeply wrong. We don't want to make our money selling things that are bad for people. And then Warren wanted to interject here. And obviously Charlie, being the sort of leader or the mentor here in this case, really shouted over Warren and took over. And he literally shut over all of these day traders and Robinhood bros. What do you make of that?
I agree to an extent. So I agree to the point that he says it's morally it's morally problematic. Payment for order flow, for those that don't understand, is they sell the information on the trade to larger hedge funds or larger proprietors of cash and capital allocators, such that they can then make decisions on the bulk of people's trades. So essentially what you're doing is there's an asymmetric trade there based on who has more information. Robinhood is facilitating that. And so the reason that's morally problematic is that, well, you're essentially giving the people with power even more power by giving them more access to information on where the trades are going to hit. And so I agree with him on that. The bit that needs to come out from any discussion about Robinhood is that it's enabled a lot of people to trade, and it's enabled a lot of people to engage in the stock market. That was going to happen regardless of COVID. COVID just accelerated that because people got bored and didn't have anything to invest in. So by putting the spotlight on Robinhood, what you have to make sure you do is to give them praise for what they have done over the last 2 or 3 years, but obviously hold them to account for how they make their money. The problem is this type of system, this PFOF system, wouldn't exist. Robinhood wouldn't exist without it. None of these trading apps would exist without it. So you have to give them prop for finding an innovative way of getting in on the market. How that actually pans out in the market, what that does to the general market in terms of positions and how the market's going to be moving is up for debate. But yes, you're right. The whole trading on options without knowing what you're doing is definitely dangerous. And that's something that can be developed through better education and better regulation of players like Robinhood. But, I like Uncle Charlie's view of it better.
I mean, there's a way of providing positive sum democratization. But then on the other hand, where Charlie said, we don't want to make our money selling things that are bad for people. I saw a few tweets that were sent to me where people said, this is coming from the guys who sell Coca-Cola that causes diabetes and sees candy. And I said, well, hang on a minute, because then you could make this argument for everything. You could almost make this argument for everything. You could say, oh, the auto manufacturer who causes fumes, or the bankers who get bailouts, or literally anything and everything. I mean, a Coca-Cola here, and this is not beer, I do not drink alcohol. This is like a once a week treat. It's fizzy, it's got sugar in it, but I enjoy it. And once a week is fine, because life is all about balance to an extent. And so Coke is once a week, twice, fine, within balance. But then someone also criticized him. One of the shareholders said, what about owning the Chevron stock and other fossil fuel companies? And Buffett said he has no issue owning this, and he expected the company to be a benefit to society in the future as the world moves towards more renewable energy. People who are on the extreme of both sides are a little nuts. I would hate to have all hydrocarbons banned in 3 years. It wouldn't work. And on the other hand, what's happening will be adapted to over time. And then we went on and went on. And then Munger says, while he and Munger have sworn off tobacco stocks, they have owned retailers who sell cigarettes, i.e., I mean, Munger's always been a proponent of Costco. So there's something about every business that if you knew it, you wouldn't like. If you expect perfection in your spouse or in your friends or in companies, you're not going to find it, Munger said.
Correct.
And so people are nitpicking, and somewhere Charlie, where they got questioned, why don't you make more climate-friendly investments? Charlie's response was, we don't know all the answers on global warming and all these topics of diversity and all of these people with liberal arts educations asks us. 1-0 and there's zero comeback. Leftists, socialists, social justice warriors with liberal arts educations who've never worked a real job in their lives. It's a great answer. But yeah, essentially, look, you can make a fault out of any investment. I mean, look at Iman. Like, I could pick many faults out of him, but I see him.
I am what you would consider perfection.
Cool. So next topic, which you wanted to touch on, was Bitcoin. I'll let you take it away.
I mean, look, Bitcoin. Where do we start with Bitcoin? Look, fundamentally, everyone knows what the potential or the world could look like if Bitcoin was taken on and regulated properly, etc., and whatever. But what people know, and what I think Munger and Buffett were talking about, was essentially the majority of trades, the majority of money entering those markets is speculative. And when you have a speculative market that is based solely on people wanting to make more money, the use case behind that thing gets lost. Now, historically, both guys have actually come out and spoken against the use cases of the technology because they just see it as another technology. In fact, Jason Calacanis recently, an angel investor, came out and said the same thing on his Twitter and got absolutely roasted for it. There's a nuance here that needs to be seen with what Munger's saying, which is that he sees it as a bit of a disaster and an absolute scummy thing to be involved in, because fundamentally it adds no value beyond increasing people's pockets. That's all it does at the minute. Until the point that we see widespread usage of Bitcoin or widespread usage of any cryptocurrency beyond the blockchain, specific to the currency, then I just think that's a legitimate way to feel.
I mean, Munger said, I think the whole damn development is disgusting and contrary to the interest of civilization. A financial product invented out of thin air. Of course I hate the Bitcoin success. I don't welcome a currency that is so useful to kidnappers and extortionists. Anyway, moving on.
Moving on to the last craze that they spoke about, which was SPACs. It comes as no surprise that they don't like SPACs. They say it won't go on forever. Buffett says it's a killer. The SPACs generally have to spend their money in 2 years, as I understand it. If you put a gun to my head to buy a business in 2 years, I'd buy one. And there's always pressure from private equity funds. He's got a point, right? We spoke about this on one of our episodes.
I love this.
We spoke about this on one of our episodes on SPACs, where we broke down SPACs from first principles. But what he's basically saying is that it's very easy to be someone that manages a SPAC, to be a SPAC sponsor. And it's very easy for them to make money, actually a lot of money. But the fact, I think it was posted on LinkedIn somewhere, where the number of SPACs this quarter is like 1/4 of what it was last quarter. So there's already a dip being seen in the market immediately. So he sees it as a quick fad. He thinks that the market's going to get smart to this. Therefore, SPACs are going to die out pretty quickly. And I think we agreed with him, but 4 or 5 months ago.
What do you make of the performance of Chamath's SPACs?
Haven't they flopped recently?
Yeah, that's why I'm asking.
A couple things. One, I'm not surprised But at the same time, I feel that he can actually improve the performance of those SPACs. 2, I think he's been shooting from the hip a lot. So he's been using his brand to invest in as much as possible while essentially striking while the iron was hot. And then I think there's a overarching thing, which is I think he's branching out of tech now to a certain extent. He's going to be taking Equinox public. I think what he's done is essentially use SPACs as a method of bolstering his position in the investing market, essentially riding the wave of retail investors in the market to kind of put money behind him, and then really make his money in the following sort of 5 years. Basically, that's what I think he's been doing. What's your take on Chamath?
Too soon to say, but based on the performance of... Initially, obviously, we all caught the Chamath bug. We were like, what a great guy, and with his salesman abilities. And I still think he's a great, talented guy, but based on some of the returns he's produced over the last decade and the investments he's made generally, whether it's been VC or in the markets. Too soon to criticize, but you do have to start questioning some of the dips. We'll see in 10 years if Chamath is on his way to becoming a future Berkshire with social capital and what he's doing.
Yeah, you're right. If we're measuring Buffett and Munger by a 60-year timeline, we should probably do the same with people like Chamath and give him the benefit of the doubt. It's just the fact that he makes so much money off the follow-on pipes and dilutes people's shares from these SPACs that kind of pisses me off. But each to their own. He's got to eat, and he's eating good.
Buffett said if you're running process for somebody else and you have only upside with lots of fees and no downside, you're going to buy something, of course, referring to skin in the game. Frankly, we are not competitive with SPACs. It's where the money is now. Wall Street goes where the money is. Stick a famous name on it and you can almost sell anything, but it won't last forever. And goes back to what we've been saying. And then the Keynes quote, which we'll throw up, which he brought up as well, regarding the casino-like behavior. Nothing wrong, Warren said, nothing wrong with gambling, but you essentially got gamblers entering the market in the past year, everyone opening up a trading account, etc., etc. And Charlie said, easy money like SPACs and derivatives, you push it to excess and it causes serious problems to civilization. No credit to those doing it and no credit to regulators allowing it. It's shameful. Not just stupid, but shameful. Don't care how much money is in it. I don't like the professionals that take the suckers, the gamblers. So there you go.
Who takes over? Let's close this out on Uncle Charlie and Uncle Warren. Who takes over? They seem old, they seem frail, but at the same time, they kind of still got the same energy when they sit next to each other than they did 15, 20 years ago. So, it could be another decade before they're gone. But who takes over? What are the rumblings in the market?
It's funny because Charlie said something. He didn't directly give it away, but he hinted at it, that Greg Abel is the successor of Warren Buffett. Because people were questioning, is it going to be Greg Abel or is it going to be Ajit Jain? He's actually I looked at his CV when I first came across his CV. It was ex-McKinsey and Harvard MBA and whatever. I think something along those lines. So you're a typical corporate bro. And I was like, no way, I'd want this guy in charge of Berkshire. But when he opened his mouth, I was actually quite impressed. He is in charge of all the insurance operations of Berkshire Hathaway. And then Greg Abel is in charge of all the non-insurance operations and investments. So Charlie basically gave it away in the meeting that Greg will be the successor. And I would have loved to have been in the room after the stream to see Warren say to Charlie, what the hell? Because 2 days later, or a day later, they had to announce, yes, Greg Abel is the successor. My thoughts on Greg Abel as a human being, well, I don't know him personally, but from the exterior and how he presents himself, seems a great guy. However, and not just me, I was thinking this and I engaged with a few Berkshire nerds in the Reddit subs of Berkshire, and we all think the same thing, which is this is a very corporate-y, polished guy. This is the opposite of Munger and Buffett. Every time he gave answers during this stream of this annual meeting, he would give very long, politically correct answers, very sort of sugar-coated, and he would say, as Warren just stated, and based on Warren's he's not a Buffett or Munger, and he doesn't have that charisma and character. But then if you were to think critically, this guy is not here to entertain us. Yeah, this guy is here to run a holding company and manage investments. So we'll see. As long as the numbers do not lie, numbers don't lie. I think Pusha T, did he say numbers don't lie? Someone said it. Numbers don't lie. So let's see how his numbers stack up over a long time span in the future.
What's telling is that Munger said Abel will keep the culture, And that's really interesting because Munger is a good judge of, well, supposedly a good judge of character. We don't know him personally, but from everything we've seen, he's somewhat of a good character judge because he's stuck himself with Warren for this long and only sticks with people that he respects and wants to work with. So given that he said that, it's evident that he sees value that's going to come from Abel, and he trusts him, which is, I guess, the most important thing.
I anticipate, I don't want it to happen. It will be a very sad day. I mean, freaking half the wall here is portraits of these two guys. But when one or both of them pass away, when it happens, I think when the first one of them, especially Buffett, it'll hugely impact the Berkshire stock price. And I think there will be a big sell-off because a lot of people who have been in, as Buffett says himself, these are people who, this is their only investment. This is their retirement. And they've invested because they're in it for a multi-decade game, solely for the two guys running it. So you have to question when these changes happen. I think there will be a big drop in the Berkshire stock price and it will not recover probably for a long time until Greg Abel proves himself. But that's my thoughts. And they grilled him on why don't you ever bring Ted and Todd on stage in the annual meetings? And he said, well, if you had two guys who had all the answers and secrets to your business, would you bring them to get questioned and give everything away? Of course not. They seem like impressive guys. Let's see. Too soon.
Yeah, I think it is too soon. On that note, we've talked about old uncles Charlie and Warren. Is there anything else you want to pick up from the meeting that you thought was interesting?
Nah, I mean, there's a lot we could go into, but Charlie, as usual, shared a lot of wisdom on life and things, which I love, his philosophies. But otherwise, yeah, pretty good meeting. I mean, the energy was a bit low, of course, because there was no audience initially, but then the banter started rolling out. Charlie was, of course, not short of multiple cans of Coke and See's candy, enjoying himself. But yeah, look, I hope next year we're all there in person, and I look forward to it. I will probably sell the Berkshire BRKB shares that I've got when the first of them goes, because I've held it for a while, and in an ideal world I'd hold on to it till I die, but these guys are going to die before me by the looks of it, based on probability and statistics. So I'm going to sell. But you then ask, where would you put your money? Well, fortunately, I'm already in Fundsmith and I'm always looking to top up. Terry Smith is still fairly young, and he's a growth investor who's produced phenomenal results. He's known as the English Warren Buffett, and that's the money manager I'm betting on for the foreseeable 2-3 decades, hopefully, at least.
Fair enough. Each to their own. I'm betting on Chamath.
All right, cool. Strong opinions, loosely held. Thanks for tuning in. If you don't want to watch these in the future, you can also listen to them on Apple, Spotify, all of that shit. We upload it everywhere.
Check out our essays online as well. We do really, really deep, insightful pieces, not like the shit we chat on these streams.
Yeah, rationalvc.com. These streams are more for us to shoot the shit, even though we try to discuss overall concepts from a Lindy standpoint, the concepts behind the things that we discuss, and hope that it withstands the test of times. Anyway, rationalvc.com. Join the many people who subscribe, and peace.
Peace.